Welcome to Did You Know? Welcome to this video where we will be exploring the secrets of banking and how banks really make money. Many people believe that banks make their money simply by charging interest rates and fees, but the truth is that there's much more to it than that. So, let's dive in and discover how banks make their money. Section 1. Interest rates and the spread. Banks make a significant portion of their income through interest rates. The interest rate is the cost of borrowing money, and it's usually expressed as a percentage of the total loan amount. Banks make money on interest rates by charging a higher interest rate on loans than the interest rate they pay on deposits. This is called the spread, and it's how banks make a profit on loans. For example, if a bank pays 1% interest on deposits and charges 5% interest on loans, they make a 4% spread. The spread may not sound like much, but when you consider the billions of dollars that banks deal with every day, it adds up. That's why banks are always looking for ways to increase their spread, such as by offering lower interest rates on deposits or increasing interest rates on loans. Banks also use a variety of techniques to manage their interest rate risk. For example, they may use interest rate swaps to exchange fixed-rate interest payments for floating-rate payments, or they may use options to protect themselves against interest rate changes. Section 2. Fees and charges. Another way banks make money is through fees and charges. Banks charge a range of fees, such as ATM fees, overdraft fees, and annual fees, to name a few. These fees can be frustrating for customers, but they're a significant source of revenue for banks. In fact, some banks make more money from fees than they do from interest rates. Banks are continually introducing new fees to generate more revenue, and some customers may feel like they're being nickel and dimed. However, it's important to note that not all fees are bad. For example, if you're traveling abroad, it's often cheaper to withdraw cash from an ATM than to exchange currency at a foreign exchange bureau. Section 3. Investments. Banks also make money through investments. When you deposit money into a bank account, the bank uses that money to make investments in various financial products, such as stocks, bonds, and mutual funds. Banks earn a return on their investments, which they can then pass on to customers in the form of interest or dividends. Investing can be risky, and not all investments turn out to be profitable. Banks that make poor investments can suffer significant losses, which can ultimately lead to bankruptcy. That's why it's essential to choose a bank with a strong track record of financial management and investment strategy. In recent years, there has been an increased focus on ethical investing, and some banks are now offering investment products that align with customers' values. For example, some banks offer investment products that prioritize environmental, social, and governance (ESG) factors. Section 4. The importance of banks. Banks are an essential part of the financial system, and they play a crucial role in the economy. They provide loans to businesses and individuals, which helps stimulate economic growth. They also offer a safe place for people to store their money, which helps prevent theft and fraud. However, the banking system is not without its flaws. One of the most significant criticisms of banks is that they can be too big to fail. In other words, if a large bank were to collapse, it could have disastrous consequences for the entire economy. That's why many people believe that banks should be broken up into smaller entities to reduce the risk of a catastrophic failure. Another issue with the banking system is the lack of access to banking services for certain populations. In many countries, there are people who don't have access to traditional banking services, which can make it difficult for them to save money or access credit. This is known as financial exclusion. Some banks are now offering alternative banking services, such as mobile banking and prepaid debit cards, to help address this issue. Section 5. The future of banking. The banking industry is constantly evolving, and there are several trends that are likely to shape its future. One of the most significant trends is the increasing use of technology in banking. Digital banking has become increasingly popular in recent years, and many banks now offer online and mobile banking services. This allows customers to access banking services from anywhere, at any time. Another trend is the rise of fintech companies. Fintech companies are startups that use technology to offer financial services, such as mobile payments, peer-to-peer lending, and robo-advisory. These companies are disrupting the traditional banking industry and offering new and innovative ways for people to manage their money. Finally, there is the issue of regulation. Banks are heavily regulated, and there are many rules and regulations that they must adhere to. However, there are concerns that some banks may be engaging in unethical or illegal behavior, such as money laundering. As a result, there is increasing pressure on regulators to ensure that banks are behaving ethically and following the law. In conclusion, banks make money through a variety of sources, including interest rates, fees, and investments. They are an essential part of the financial system, and they play a crucial role in the economy. However, the banking system is not without its flaws, and there are concerns about the size of banks and access to banking services. As the industry continues to evolve, it will be interesting to see how these issues are addressed and how banks continue to adapt to the changing landscape.